Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv Narayanan, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. All right, everybody, welcome to the podcast. It's going to be a different type of an episode today. I'm going to be doing it solo. And the reason for that is that we've been seeing a lot of central themes emerge across a lot of our private equity partners, our clients, CEOs that we speak to, and even revenue leaders. And it sounds a lot different than, let's say, even 6 months ago or going back a year or 18 months. Sounds much, much different. And we have a bit of a unique perspective here at How to SaaS because we're like this outside party to these companies, and we're so close to the private equity ecosystem. That's one of the reasons why we run this podcast. And I spend most of my day talking to our customers, talking to our partners, talking to our clients. And so I get to hear day to day how the market is evolving and how everybody's perceiving things in terms of deal flow, whether pipeline is closing, are private equity investors raising enough funds, have they been able to exit their investments, are they getting the right kind of valuation for their companies? And over time, you start to build a pretty good picture. I mean, I've been doing this for about 6 years now, running this business, and every year I can see how the macroeconomic environment translates into the private equity world and how investors are perceiving companies and making investments and growing their respective businesses. So wanted to do the episode today because one of the big themes that I'm seeing is that companies in general are not hitting their sales targets. And this might sound like your business. It might sound like 5 out of the 7 portfolio companies that you're investing into. It's not to say that every company is struggling, but it's more that I would say a larger percentage than usual are either have seen their growth slow down or are seeing even like an even year compared to previous years. And that's very different than, let's say, back in 2022 or 2021 and even 2023, where companies have been consistently growing, consistently expanding their margins or expanding their EBITDA and able to grow a lot faster. And at the same time, we are seeing something else happen on the investor side, because as companies have struggled to grow or reach the targets that have been set by investors, it's become harder for investors to exit the investments that they have already deployed capital into. And actually, if you listen to some of our other episodes, a lot of investors touch on this topic. And we've even had guests that have talked about how a lot of funds are focused on secondaries as a way to find liquidity for their LPs. So you kind of have this perfect storm or a situation where the company's not growing as fast as it wants to, and then the investor needs liquidity to be able to send it back to their LPs to raise their next fund. And yet there's this tension because to find more growth for the company is proving to be difficult, and this is a bit of a timely issue for the investor. And so it becomes even more important in this time to find ways to grow. And from the investor's perspective, I've seen the focus shift. I'd say 4 or 5 years ago, when we were in the early days of this business, we were getting pulled into deals where tons of platforms were coming together, capital was being deployed everywhere because debt was easy to find, and a lot of companies were being merged together or being invested into, and a lot of value creation planning and work was being done, but mostly M&A was the big focus because capital was so easy to find. Then in the last couple of years, the focus shifted inward to existing portfolio companies and optimizing performance and helping those companies grow. And that's in the last year or so, the focus has been on getting more liquidity back to the LPs and becoming more efficient. And that trend can easily spiral out of control if PE firms are not able to grow their portfolio companies, are not able to exit their investments at some point, and are not able to provide liquidity to their LPs. I think there's a chance that if this trend continues, you're going to start to see some PE firms even go under because they are too leveraged, or the debt covenants are too high, or the companies are not growing fast enough and they're not returning enough capital to their LPs, or at the very least, they're going to struggle to raise their next fund. And we've seen this with some PE firms that we know where they raised fund one, fund two, fund three, and now it's been a while before they have raised fund four. And I'm not talking about the top of the top PE firms, because those firms will always have LPs interested in investing. But there's this long tail of middle market firms that we work with and that are actually investing in a lot of companies that don't have the same resources or the same track record to be able to raise subsequent funds without having proven out the existing fund's ability to return capital. And then on top of this, you have AI as like this additional pressure that has changed the landscape. On the one hand, it's introducing existential risk, because you kind of have to look at every investment through the AI lens to figure out, will this company actually still be around in 1 year, 2 years, 5 years time, or will AI platforms kind of displace this current SaaS platform that we have that is potentially growing or is potentially a good business? And then on the flip side, you also have this AI threat on the go-to-market side and in just on the product side, where there's all these other competitors emerging, because AI has made it much easier to code a competitor, to launch a competitor, to launch campaigns on the marketing side or do sales outreach much faster. So it's more competitive than ever on the go-to-market side. And then yet you have this existential risk where you kind of have to keep investing in product, and you have to have some sort of a AI component to be relevant, or at least be able to say to the market, like, hey, we are AI enabled, or we are AI driven in terms of what our platform is, because a lot of competitors are using that language as well. So you have this perfect storm. And then on top of this, you also have the macroeconomic conditions, the political uncertainty. Interest rates were just cut by, I think, 25 basis points, but it's unclear as to how long the interest rates will be as high as they are. And then you also have just geopolitical issues that are putting a lot of deals at risk, or certain deals are not closing. So even on the deal side with the private equity funds, we're seeing PE investors invest in fewer deals. And the deals that they are investing in are usually the blue chip assets, and there's a ton of competition, and valuation for those are quite high. But we've seen a lot of deals fall apart during diligence this year with the private equity partners that we're working with, because certain metrics are not met, or the companies are just not high quality enough for them to be willing to take the risk associated with all these other existential threats surrounding a particular market or vertical that they're kind of investing in. Regardless of whether or not they believe in their investment thesis, they're looking for really great assets. So you kind of have this perfect storm where it's really important to build companies that have strong foundations, that are able to see this uncertainty through, and are going to kind of stand the test of time and have the ability to grow in the uncertainty. And that would help PE firms, one, deploy their capital, and there's a ton of dry powder sitting on the sidelines. And it's going to help the companies themselves either find a PE partner to exit to, or if they're already owned by private equity, to find a subsequent transaction so that capital can be returned to LPs. So that's how all of this connects together. And the way I see our role in this ecosystem is that we're almost like a value creation partner to all of these firms and even founders that are looking to exit to PE. And we are trying to help them figure out what are the best things that they can invest into in order to meet a lot of these objectives, whether it's building more pipelines so that they can have a predictable revenue engine, so that the company can grow faster and maybe more likely to exit, whether it's figuring out how to leverage AI to scale faster or produce more content or become more efficient, whether it's to become more competitive in a marketplace that is now surrounded by all kinds of ubiquitous competitors that offer similar features or similar benefits. And so I see us as the player in this space that is kind of like this value add partner that's going to help everybody navigate some of this uncertainty, especially with the functional expertise that we have in the domain of marketing. And so with all of that context set, that kind of is what leads me to kind of focus on what I want to talk about today, which is, okay, let's say you do have a company where growth has slowed down, or at least it's not growing as fast as you would like. So instead of, let's say, 35 or 40%, maybe it's growing at 15 to 20%, or it's decreased from 25% to 15%. And so business is okay in general, but not growing at the level that you'd want it to. And pipeline is not closing, revenue targets are being missed, and there's this pressure being put on this company to scale faster, but it's really hard to figure out what to do. Should you focus on generative search? Should you do ABM? Should you leverage intent data? There's all of this noise in the marketplace about what you should be doing, and it's unclear on which ones are actually going to help these companies succeed. And I really want to simplify the whole process down for you on today's episode. So let's start with the basics. One of the things that happens especially when I meet go-to-market teams or when I meet revenue leaders or even CEOs, is that companies are drowning in opportunity. There are hundreds of ideas, hundreds of initiatives that can be funded, and everybody in the room thinks something or the other should be invested into. And it's really hard to figure out whether you should do Project X or Project Y. And meanwhile, time is of the essence. And every week that passes or every month that passes where we're not addressing this underlying problem of growing faster, targets are getting missed and the pressure is building, right? And so, that's what we want to fix. So what we want to get to is, I would say, strategic clarity. Clarity on exactly what is going to move the needle and what are the areas we need to focus on to create as much enterprise value as possible in as short of a time as possible. We often get this question from investors and CEOs like, I want to grow faster or I want to create more enterprise value, but I want to do it yesterday and I want to do it quickly. What are the quick wins? How can we do this faster? I want to do it in 2 weeks. I don't want to do it in 2 months. I want to do it in 4 weeks. I don't want to do it in 4 months. And so there are a lot of things that can be done like that, but it requires a structured approach. And I'd say there's an order of operations to all of this. So I'll start with some principles. One is just that you want to focus on a limited number of areas. You are not going to figure out ABM plus generative search plus product marketing plus launch a new website plus do a brand redesign. And I could list 7, 8 other projects all in one. It's highly unlikely. I mean, if you're like an $800 million company, probably it's doable if you have an exceptional CMO. But even then, I would say that it's going to be really hard to do because that person's also going to have integrations to manage, there's events to do, there's sales enablement work. There's just business as usual activity that keeps everyone busy. So in talking about creating enterprise value as quickly as possible, you really want to have a laser focus on 1 to 3 areas max. And I would say out of everything, you want to start with the revenue that is most likely to close in the shortest period of time. So as an example, if you have this idea of, for example, launching your own podcast like this one as a way to meet your own customers, it's a great idea in a lot of verticals and markets, and it can be a great form of account-based marketing. I can tell you that we've driven millions of dollars in revenue from just having this podcast. However, in order to invest into this, you need to have the patience to see it through for 18 to 24 months before you start to see that type of a return. So even though it's a good idea, it's not a great idea to get you the kind of return based on the pressures that we have just discussed. And so I would kind of put that idea and say it's kind of a nice to have or something that we do much later on and not something that we do right now. And then the third thing I would just say as a guiding principle is to drive as much cost efficiencies as possible. And the reason I say this is that there are companies out there that might be growing or their growth has slowed down, and that's changed their margin profile significantly. A company that was growing 30% year over year, but had expanded its cost base can easily go from EBITDA positive to EBITDA negative overnight. And in that type of a situation, that Paul Graham has a saying, it's like, are you default alive or default dead? And default dead meaning you're burning cash every month, and at some point you're going to run out of cash. In a PE-backed environment, obviously that's less likely, but the point still stands is that you want to be as default alive as possible, and finding cost efficiencies can help you do that while you try to look for the quickest wins to drive more growth and pipeline. So with those 3 principles, I would say here's kind of how I would go about this for basically any business. And you can apply this to any one of your portfolio companies today. And that's what I'm trying to make this as actionable as possible. So we are going to get tactical right now, and it's going to help you. So just stick with me as we kind of go through this list. And I'm going to give you specific types of campaigns and programs and initiatives that the company should be focusing on to address this pipeline and revenue problem in the short term, and then we can expand into the longer term initiatives that are kind of out there. So starting with efficiency, I'd say number one is stop the inefficiency inside the business. Every additional dollar that you find an inefficient spend is an additional dollar of EBITDA that should go to the bottom line. And I can tell you that when we come in and do our analysis inside companies, we are finding anywhere from 30 to 50 and sometimes even 70% of marketing spend being wasted in avenues that do not generate a return that is valuable enough for the business, yet they're spending hundreds of thousands and in some cases millions of dollars into campaigns that don't work. And so how we do this, I'd say the specific areas to look into, especially on the marketing side, would be to do a deep audit of the paid media spend. I would say companies are definitely wasting 30 to 50% of their spend here. And the issue is that they don't have the right data tracking to be able to figure out which 30 to 50%. But if they actually tracked everything to close one in revenue, they're going to find a ton of efficiency. Number two, look to reduce channel spend by this 80-20 rule, which is that inside every channel, I would say 20% of the initiatives are actually driving 80% of the revenue. And if you just kind of look at it like that inside every channel, whether it's events, whether it's outbound, whether it's ABM, whatever you're kind of investing into, online, offline, what have you, you're going to find a ton of inefficiency. If a channel you're spending, for example, $500,000, I would argue 150 to 200,000 max is driving most of the value. So if you can bring that 500,000 to 150 and save the 350 through to EBITDA, you're already significantly farther ahead than trying to use that 350 in an inefficient way to drive way more pipeline than you need to justify that 350 in spend. That 350 in spend should be generating over $1 million in pipeline and revenue for the business. And if it's not, then you are much better off letting it go down to EBITDA. Then third, I would say is segment out the work that is essential from nice to haves. And I think connected to this is this idea that I would say the 80-20 rule for programs also applies to activities and it also applies to teams. So if you look at your marketing or your go-to-market organization, including sales and the marketing side, I would say 20 to 30% of the staff is likely driving 80 to 90% of the value. Those are the true A players. They are the keepers. They're the people you have to build around. You should not be losing them at any cost. And yet, the other 70%, the return on the value or the work that they're doing is kind of like a question mark. And there's a ton of spend going into these roles. Some of these roles are in senior leadership. Some of them are middle management. I've seen cases where companies have multiple executives that are making over $300,000 or $500,000, and they are not essential to what the company needs to do to grow pipeline. Just an example, we helped one company cut over $20 million in marketing spend, and their revenue did not change at all. And we have over 2 years worth of data on that. So just to give you that context, and this is obviously a much larger business, but we've seen it at a smaller scale too, where we've cut $500,000, $1 million, $2 million in spend, and it hasn't made any difference. So being able to right size your team and your activities and to look at what is actually essential work, the core work that we have to do to move this business forward in leaner times so that we can preserve as much cash as possible, be default alive, and get that down to the EBITDA margin as much as possible is the right way to kind of think about it, especially at this moment. Is maximizing existing customer value. So pricing is one of those levers that is often looked at, and I would definitely look at pricing, and obviously PE firms are very good at this, and there's people on the operating teams that are always doing this kind of analysis. I'd say pricing is one of those tricky things, especially at this moment, because what you can do with increasing prices is you might find expansion revenue, but especially at this moment, you might trigger way more churn than usual. So you have to model for increased churn at this time before you just try to leverage pricing as like your expansion revenue or almost like a get out of jail free card in this time. The other thing I would say is leveraging pricing as an advantage where you're experimenting with different models so that you're driving more upsell or cross-sell or expanding the existing base or even helping you close net new deals because maybe flexible pricing terms, as an example, you don't need to lock them in for 5 years or 3 years, maybe a 6-month contract will get the customer in the door, and then you can focus on retention after the fact. So I think pricing can be a huge one, but the bigger point here is that you want to focus on your existing customer base because they're already transacting with you. And especially at this time, I would say a lot more effort needs to be put into the existing base because they're buying from you, and expanding that relationship will be a lot easier. And there are many ways to do this, regardless of what type of business you are. So, for example, if you are a, a SaaS business, then obviously then we have to talk about seat expansion or upselling, cross-selling other products and solutions. But let's say you're not a SaaS product, you are more of a services business, and the clients that you're working with are cutting headcount. Well, that becomes an opportunity for you to offer managed services solutions or fractional solutions, or ways to kind of provide on-demand talent to them as a way to supplement the talent that they've lost or the productivity that they've lost without having the same cost base or fixed costs associated with the headcount. So figuring out ways to be creative with the existing customer base and sitting down with the specific organization and going, what is everything we can do to increase our total customer value from each of our respective accounts, I think should be one of those top 3 initiatives that we discussed. Because more than anything, that will move the needle in the short run because you already have those relationships and you can get the call, and the likelihood of closing those deals, the close rate should be above 70% because you have the relationship. Fifth, I would say, again, lost track of the numbers I was on. But fifth, I would say, is focusing on close rates on opportunities. So one of the things that's happening is, okay, if somebody's getting to qualified status, if they've put their hand up and they've said, hey, I'm interested in buying from you, or at least let's do a demo. You do the demo, you've had a great conversation. Obviously, it's a great fit. You discuss pricing. Everything seems to be working well. And for some reason, the deals fall apart, right? So at this stage, if you're getting us X amount of deals, one of the things that we're hearing from PE partners and our clients is that close rates have declined quite significantly. So if they used to be, let's say, 40%, companies are now seeing 25% close rates. And that's the difference between closing 40 deals or 25 deals. And if you do it at a $10,000 a pop, that is a significant amount of difference in terms of new ARR or expansion ARR that you're kind of capturing. So what you want to do is anybody that walks in the door that becomes a qualified sales opportunity, you want to overinvest into helping that deal cross the finish line. Where previously you would run them through your standard process, you want to provide a lot more resources, a lot more support, a lot more references, a lot more assets. You want to provide a lot more value earlier in the deal cycle so that you increase their confidence and you have more buy-in to get that deal over the finish line. It's not just about sales enablement. It's about providing a lot more value pre-close so that you increase the likelihood of the close at the point of sale. So I'd say this is something that often gets overlooked because after a certain amount of time, a company's closing process is how they've always done things. And they don't always think about that being a problem. And it's not that it's a problem. It's just that customers are in a different situation. So the amount of effort required is significantly different than, let's say, used to be 2 years ago or 5 years ago. And so you almost have to kind of do a refresh for the closing process from op to close and think about what are the 10 different things you can do during that specific window because they're already in your pipeline. There's a certain amount entering your pipeline every single week. So what is everything extra you can do to get that deal over the finish line? And just do that with your whole team. There should be weekly syncs with marketing, with sales enablement people, anyone, customer success, to make sure that that prospect gets over the finish line, or at least you're doing everything in your power to get them over the finish line. And the larger the deal size is, the larger the effort should be. So if you're doing $100,000 or even $15,000 deals, I'd say get everybody in the room and prioritize all the deals and then just go one after the other and give them as much value pre-close. And that will increase your close rates back to at least some level of normalcy that you were previously seeing. Connected to this, it's number 6, number 7, is the idea of re-engaging deals that have entered into closed lost. One thing to understand about closed lost deals is that closed loss is never just closed loss forever. There's many reasons why deals enter closed loss range, and you have to try to figure out what you have to look at the data and figure out why did this deal enter closed loss, and you have to re-engage them as a way to see if you can reignite the opportunity status of this deal. And I'll give you some examples. If a competitor, if a deal went to closed loss due to a competitor, the way to check in is to say, hey, company X, I know last time we spoke 6 months ago, you had chosen to go with HubSpot instead of our CRM. Wanted to see how the migration process was working out for you. Are you having any hiccups? Is it delivering the results that you want? Is there something else that you wish you had? Or is it worth it for us to reopen this conversation? Odds are somebody that went with a competitor is not as likely to come back, but every so often, let's say 5%, 10% of the time, you're going to find a customer that is quite unhappy with the choice that they've made. And now you have a deal that's more warm than a lot of deals that are in your existing pipeline because they've already made this investment. So they've already crossed the threshold into, I'm going to invest into this. They're just not happy with the results. So they have a vested interest in making it work. And so that's an example of a deal that can close sooner. And this is a very tactical campaign because it's hand-to-hand combat. It's having a full list of potential deals that you can kind of work on and going through them one by one, similar to the opportunities that we just talked about. Okay, next is closed loss to no decision. In this case, it could be somebody that didn't end up buying from you because they decided that right now they just don't have the time or it's not a priority. In these cases, it's worth it to reach out and say, hey, I know when we spoke 6 months ago, this wasn't a priority for you. Is it a better time to pick up this conversation? And maybe we can show you some additional things that we can do in this time to help you kind of figure this out. I would say this one is a much bigger opportunity than the competitor one because this person has not yet picked a solution and likely the problem and the pain point still exists. So going through the closed loss list and finding all the no decisions and having this conversation is super important. The third one would be on pricing. If you lost a deal due to pricing, we just talked about pricing as a lever. Going back to all of these customers with either more favorable terms, more favorable structure, maybe updates to pricing, maybe ways to look at the ROI of an engagement and re-engaging with them can open up a bunch of opportunities. So for example, hey, last time we spoke, we had talked about a project over, 6 to 12 months that would cost X amount of dollars. Just wanted to let you know, we also now offer retainer pricing and that would lower your risk and it's in a piecemeal fashion. So you can cancel at any time and that reverses their risk. And now that same deal potentially reopens because this person is able to get the approval for the budget to see how this goes for a couple of months before needing to commit any further. And I would say there's probably one or two or maybe 10, depending on your volume, a bunch of deals sitting in that column. So I'd say going through these closed loss deals, you're going to find, I would say, let's say in a given month, you close 100 deals. You might find just through a re-engagement campaign that goes through closed loss to competitor, closed loss to no decision, closed loss to pricing, closed loss to timing, or closed loss to other priorities, you might find 5 to 10% lift. So instead of 100 deals, you might close 110 deals in a given month. And those 10 deals can be the difference between making your month and quarter and not making your month and quarter. So while it's super tactical, it is very much in the moment and it's a quick win that you can capture in the short run. Okay. Next, I'd say so far what we've covered is what you can do tactically to it's almost like what you can do today or this week or next week to build pipeline in the immediate term. I'd say the next set of ideas are things that you can do today or next week, but require a little bit more time to see the results, but not as much time as a longer term initiative. So the first of these ideas I'd say is to maximize your existing channels. Similar to how we cut spend in areas that don't work, or are just too expensive, there are channels that are doing quite well for you, that are driving pipeline and revenue at a really good rate, but you just haven't spent enough in those channels or scaled those channels to their maximum. So what you want to do is figure out which channels are driving the most amount of revenue and pipeline and most efficiently for you, and figure out based on effort or investment required in order to scale those channels, stack rank and prioritize, and invest in the top 2 or 3 channels where you are getting the highest return on your investment and scale those areas. And what you're going to find here is that a lot of channels that are, or not a lot, the channels that are delivering a lot of the revenue, that are driving most of the pipeline for you are not maxed out. And we see this all the time where, again, there's 20, 30, sometimes even over 100% opportunity left on the table inside channels like paid media, like account-based marketing, like events, like different SEO, different avenues that can actually move the needle for a particular business. And there's a lot of value being left on the table because nobody's figured out what is the efficient frontier for this channel. So doing that work, looking at the data, tracking everything to close one, looking at it at a channel level, at a campaign level, and then figuring out how do we scale this faster can drive a bunch more pipeline. And it's still in the short run because it might take you the next 3-4 weeks to implement, but you're going to start to see results as early as next month. And I would say in engagements with our clients, this is one of the first things that we do because companies are not looking at the data or don't have the right data infrastructure to be able to measure all of this and figure out what to prioritize. Next, I would say focus on people who are in market today as the priority for what you are doing from a campaign perspective on the go-to-market side. So there's a hot button topic in marketing today on what's called intent data, which signals whether or not people are in market to buy, and using that as the guide to figure out whether or not this deal has the urgency or the timing to actually close this quarter, and doing your outreach based on that versus just doing outreach based on target account lists and the ICP that you're kind of going after. I would say you want to do this work, but you want to do it in the areas where you can get to people who are in market as quickly as possible. So if anyone is already in market for a solution, like let's say they're looking for construction software, well, you want to make sure that the 7-8 places where a person in market would look for a solution, you are already showing up. That could be on the digital marketing side. It could be paid ads. It could be organic search. Today, it could be generative search and how they're looking for solutions on platforms like ChatGPT. You want to make sure no matter where they're looking, you are already in front of them. Connected to this is also the idea of the intent data and the triggers associated with what a good buyer might be looking for. I'll give you an example from us here at How to SaaS. One of the big triggers for us is when a private equity firm actually deploys capital into a company. When they do that, that is when they're building their value creation plan, and often inside their value creation plan, go to market is a priority. So we have intent signals that tell us, hey, PE firm X just bought company Y. Let's reach out to our contact at PE firm X and see if we would be a good fit to help them build out their value creation plan. We've closed a lot of deals by doing outreach in this way, and it's very targeted and focused because those people are already in market. I don't need to talk to every PE firm. I need to talk to the ones that are buying companies today or have already closed a deal, because we know that they're actually working on this. They're building the value creation plan, and they're having investment committee meetings. They're having board meetings. They're having conversations at that particular time, because that is a critical moment inside PE firms. So whatever that is for your market, staying on top of that intent data is critical. Third, I would say now more than ever, it is important, or I'd say essential, to have customized and contextual outreach on every deal. In the past, I've always talked about, hey, like the lower your ACV, it's very hard to do customized outreach. And that's still true. Like if your ACV is like $1,000 a year per customer, then yes, it's hard to do customization. But in general, most B2B companies, if you're selling $10,000, $15,000, $25,000 deals, you, and more, obviously 100,000 plus, even more so, you need to have as much context and customization inside your outreach. It's not just ABM. I would say it's permission to play stakes to make any form of outbound or outreach work. And it's not just as simple as finding a trigger like, oh, notice person X at this other company as a mutual connection, let's jump on a call. No, it needs to be deeply contextual to the problems that they are having and how that connects to what you solve. And you need to give value up front, and that will increase your outreach. If you're not doing that, you're going to see your outreach efficiency go down significantly. So I would say investing into that. And the reason this is, I would say, still short term is this can be done today. You don't need an extensive playbook in order to do contextual outreach. You need a bit of a culture shift on the outbound side or the ABM side to be able to say, who are our target accounts and what are the things we can send to them in order to get in front of them or catch their attention, to help them see what is the value we can provide. And then on a day-to-day basis, sales reps and account managers or CS reps should be doing this outreach with that type of context. It should not be just going for volume. It's about the context and the deep insight or research you can bring to the outreach that will likely increase the response rates and the number of deals that you get from that. Fourth, I would say, is investing into account management more. And what I mean by this is account management, often there's like this hunter and farmer model inside companies. But I'd say the farmer model is almost left to reps to kind of farm the existing customers and the accounts. But I think account management, especially in a time like this, needs to become a core strategy inside companies where every key contact and every key account needs to have some type of relationship building effort put behind it. And then inside larger accounts, there has to be an effort being put into knowing multiple contacts, not just two or three. Like ideally, you need to know like 5, 10, maybe even 20 people, depending on the size of the account, inside each of those key accounts. I'd say this is one of the biggest risks inside companies is there's maybe 1 or 2 contacts inside a key account, and then that person leaves and the account is dead. Conversely, if you know 20 people inside that account, the odds of upselling and cross-selling are significantly higher. So I would say this idea of internal referrals, quote unquote, inside these accounts, and then farming for additional deals with those contacts while building relationships can find a bunch of quick wins in the short term. And at the same time, leveraging those contacts for introductions and referrals to other accounts that are in your key account list, or we might already have some contacts, but one contact from this account might be able to introduce us to another contact from a different account. That cross-pollination will open up a bunch of more opportunities as well. And I'd say most of the companies that we've met do not have a systematic approach of investing into account management, even though it can be such a deep and powerful lever. And then the last thing I would just say is, I would say this is more of a longer term effort, but I think it's worth mentioning, especially in an age of AI, is to build out more authentic, authority-based content. And the reason for this is the more generative search becomes important, the more you can leverage AI to produce content. There is this sea of commoditized content out there, and none of it can really be referenced. None of it really stands out. And your content is likely getting lost in that sea of content. The more you invest into thought leadership content that builds your authority and your referenceability, the generative search platforms are going to use you as their source material to give their recommendations when people ask them questions. And you're going to have an authentic voice in the marketplace that extends well beyond the commoditized sea of content that's out there. So if everybody's able, let's say if everyone's producing AI generated blog posts or AI generated LinkedIn content or AI generated slides for their webinars and things like that, if you're the one that has a human face with deep research and expertise being brought to a podcast or your webinars or your speaking and things like that, over time, all of these platforms are going to reference you and you're going to stand out to your market as well. And that's going to add this halo effect to all the other things that we talk about on the account management side, or farming existing accounts and growing that, doing your contextual targeted outreach, or re-engaging your deals, or increasing your close rates from opportunity to close. All of these areas benefit from this particular lever, and that's something that we talk about often as well. And that's one of the reasons I do this podcast, is it's all kind of connected, and you don't really see the benefit of the authority work in real time, but it does show up every single place that you go, especially when you're meeting with customers and your prospects. So I'm gonna stop there because I think those are a lot of different avenues for you to think about. There's more that I could definitely dive into, but I think if you kind of look at that list, we went through about 10 to 15 items that you could start actioning today for your portfolio companies. I think there's a lot to kind of go into. I would encourage you to share this episode with your other managing partners or your CEOs or the revenue leaders and have a tactical conversation like this where it's literally a meeting. You have a Google Doc or whatever open, and you're kind of going through each of those bullet points and listing out what are the 4 to 5 things that you can do to increase pipeline in the short term. And hopefully that helps you hit your targets for 2025, or at least catch up a little bit, and then helps you set the stage to do better in 2026 and beyond. So with that said, I appreciate you listening to today's episode. I hope you enjoyed it. Leave a comment below or just ping us and let us know what you think. And I'll see you all next time. Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosaas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.